Hello friends. So in this recording we are going to discuss derivatives, and I'm giving you a heads up. It's going to be a long recording. So what are the chapter highlights? So when investing in common shares of the company, the value of that holding is generally based on number of shares owned multiplied by the current price. As the market price rises or falls, the value of investor holding also rises or falls. Derivatives are little different from holding shares or holding bonds. The value of derivative is tied to something else, an underlying, such as a financial asset or a commodity. It is the performance of this underlying assets that determines value. So what am I going to do is I'm going to discuss this definition. I'll explain you what is a derivative, what are the different types of derivatives. Then we'll come back to these slides and then go forward. So derivative is a financial contract that has its value derived or dependent upon the value of some other asset. The underlying asset of the derivative can be a financial asset such as a stock or a bond, a currency, or even an interest rate or equity index. So derivatives you can have on financial products as well as on commodities. It can also be a real asset or commodity such as crude oil, gold, or wheat. So I'm opening an Excel. First, let us understand what derivatives are and then come back and discuss those slides. So we are going to discuss three kinds of derivatives in this Excel sheet. So the concept of derivatives, then forwards, futures, and options. There are few more things like warrants and rights that we'll discuss along with the slides. Okay. So first is, what is derivative? So I'll give you a simple example for it. Let's say you are currently based in Calgary, but you moved to Toronto and you are looking for a place to rent. So what has happened? You got a job in Toronto. You have 2 months to be there. So you have currently 2 months. But you visit your friend in Toronto over the weekend, and while visiting you look for few places in Toronto to rent out. And you really like this place. So there is this place A, let's say, and Mr. Smith is the owner, and he's offering that place after 2 months. So currently it is rented out, but after 2 months it would be vacant, which exactly suits your timeline. And after 2 months he's offering this place to rent at $1,500. So this is the transaction. So Mr. Smith says that I have a place, after 2 months I can rent it to you, but I will charge $1,500 for that as rent. So you are considering whether you should take it or not. The current rent that you find out in the market for similar properties is right now $1,500. So the current rent is also $1,500. He is asking for you basically $1,500 also, right? Now what is risk for you if you don't rent this place? What is the risk that you are facing? The risk that you are facing is 2 months down the line the property market in Toronto goes up and the rents go up. So you may not get any place at the current rate, that is $1,500. So if you don't rent out this place right now, in future prices may go up. So the risk that you face as a buyer, that is as a renter in this case, is the price may go up and you would have to pay more rent. Mr. Smith, the risk is that rent may go down. Currently he is able to rent at $1,500, but rent in the market may go down and he may have to rent it at a lower price. So as a seller, he has the risk of price going down. He may get 1,500 right now for something, but in future the price may go down than 1,500. So how do both of you mitigate your risk? So buyer has a risk of price going up. You can buy right now at a specific price, but in future the price may go up. Seller has a risk of price going down. Right now you can buy certain thing at a particular price, but price may go down in future. So how do you mitigate this risk? Both of you, Mr. Smith and you. So you get into a contract. What is this contract? Contract is to rent the place after 2 months at a predetermined rate, 1,500. So buyers and sellers are agreeing to transact in future, but at a predetermined rate. Okay. So buyer is agreeing to buy in future at a predetermined rate. Seller is agreeing to sell in future at a predetermined rate. So this contract is nothing but a derivative. This contract is nothing but a derivative. So you as a buyer are agreeing to rent the place or buy the place at 1,500, and Mr. Smith as a seller is agreeing to rent this place or sell this place at 1,500 in future. Now situation 1. Rent of properties after 2 months shoots up to 1,700. So similar properties in Toronto are going for 1,700 per month in rent. So who is benefiting because of the contract you have made? So buyer is benefiting because everyone else is renting the place at 1,700. The buyer, because of this contract, can rent the place at 1,500. So you're renting lower than the market or you're buying lower than the market, so you benefit. So you make a profit. Same way, if the rent were going to be $1,400 instead of $1,700 after 2 months, what would happen? Seller would benefit. Everyone else is giving their place at 1,400, but because of this contract, the seller is able to give this place to you at 1,500. So he's getting $100 extra. So seller benefits. Okay. So the concept of derivative is a contract to buy and sell an asset in future at a specified price. Buyer agrees to buy at a specified price in a future date. Seller agrees to sell at a specified price in future date. If price goes up, buyer benefits because he can buy lower than the market. If price goes down, the seller benefits because of this contract he can sell higher than the market. Okay, so each party having opposite risk are mitigating it. Now let us take something real. So let's say you are a country like China who is a major importer of crude. So you import crude in large quantities, and there is a country like Canada which is an exporter of crude. So we export crude. The current crude price in the market, let's say, is somewhere around $70. Okay, the current crude price is $70. So what is the risk that China faces because it buys crude? And what is the risk that Canada faces because it sells crude? So risk that they face is China is currently able to buy crude at $70. In future, the crude prices may go up and it would have to pay more to buy the crude. Canada has an opposite risk. Canada is able to sell crude at $70 right now, but if crude prices start going down, it will have to sell crude at a lower price. So what they can do, they can create a contract, a forward contract, in which China agrees to buy crude from Canada in future at $70 and Canada agrees to sell crude to China in future at $70. So they get into a contract at a predetermined price. Now, if crude goes to $80, what would happen? Everyone else is trading crude at 80, but China, because it has a contract with Canada, can buy crude at 70. So China becomes in profit. So buyer of forward gets profit if price goes up. If same way, Canada loses money. So seller, just a second. Seller makes a loss if price goes up. So if price goes up, China makes profit because it can buy at a lower price. Canada makes a loss because it has to sell at a lower price than the market price. If price goes down, let's say to $60, Canada makes a profit now because everyone else, every other country is selling crude at 60. Canada can sell its crude at 70 due to this contract with China. So seller is in profit and buyer is in loss. So these are forward contracts. Forward contracts are customized contracts between two parties. So this contract is very unique to China and Canada. If China wants to do a contract with United States, it has to do a separate contract. It cannot transfer this contract. Okay. So this contract is extremely unique. So it is customized. It is non-standard. It is traded between two parties, right? Mostly forwards are traded over the counter. So there is an investment bank who breaks the deal between two parties. So they are traded majorly over the counter. There is no exchange trading. And they have a large counterparty risk. So any country can default on its commitment. So if crude goes to 80, Canada may deny to sell to China at 70. So China faces a counterparty risk. Same way, if crude goes to 60, China may deny buying crude from Canada. So if crude goes to 80, Canada will stop selling to China, may stop selling to China. So China has a counterparty risk. Same way, if crude goes to 60, China may stop buying from Canada. So Canada has a counterparty risk. And there is generally no way to mitigate this counterparty risk except legal measures. Okay. So this is an example of forwards. Things to remember. Forwards are type of derivative. The price of forward depends on price of underlying. So underlying was crude price here. If crude price was going up, buyer was benefiting. If crude price is going down, seller is benefiting. So derivative is a contract that of which price is based on the underlying. Underlying was crude here. Then both buyers and sellers had right and obligation to buy and sell. Okay, so China has to buy and China also can make Canada to sell. Same way Canada has to buy has to sell, as well as it can make China to buy. Okay, so both parties have rights and obligations. Few unique things to forwards: they're customized, they're traded over the counter, they're not traded on exchange, they are non-standard, and they have counterparty risk. Now let's go to forward. So let's go to futures. So let's say there is Facebook stock that is traded at $140. Okay, the current price of Facebook is $140. Now you think that Facebook will go up, so you want to buy at the current price, hoping that Facebook will go up in the future. So that is your view. So buyer thinks Facebook is going to go up. Same way, there is a seller who wants to sell Facebook right now because it thinks that Facebook is going to fall in future. So he wants to get more money right now. So there are two parties, buyers and sellers, who have opposite views of Facebook. So buyer will get into a derivative contract. So he gets right and obligation to buy Facebook in future at $140. Okay, seller gets into a contract again, and he has right and obligation to sell Facebook at $140 in future. Okay, so buyer is getting into a contract to buy Facebook in future at a predetermined price. Seller is getting into a contract to sell Facebook in future at a predetermined price, right? Now imagine Facebook going to $160. What would happen? Who will benefit, buyer or seller? So in future, let's say after 1 month, Facebook is trading at $160. So who will benefit? Buyer will benefit. Why? Everyone else is buying Facebook at $160. Buyer can buy this Facebook stock due to this contract at $140. So he's buying lower than the market. So he's benefiting. So if Facebook goes to $160, buyer makes money. So there is profit to buyer. And if Facebook goes to $160, seller loses money. So there is a loss to seller. So if stock goes up, buyer makes profit, seller makes a loss. If stock goes down to $120, what would happen? Seller will make money now. Everyone is selling stock of Facebook at $120. Seller can sell stock at $140. So you are selling higher than the market price. So you will be in profit. So there is profit for seller and there is a loss to buyer. So if price goes up, buyer makes profit, seller makes loss. If price goes down, buyer makes loss, seller makes profit. So this is exactly same as forward. So what is the difference now? Difference is these contracts, these future contracts are traded on exchange. So that's the first difference. Second difference is they are standardized. So generally they are traded in 100 units. So you buy and sell units in the multiples of 100 Facebook stocks. Okay. Next, since they are traded on exchange, there is clearing and settlement. That is, exchange and the clearing agents take the counterparty risk. So if you are making profit as a buyer and seller is unable to pay you, then exchange will pay or the clearing agents will pay. Same way, if you are making a loss and you're not able to pay, then the counterparty will get his share from exchange and then the exchange will sue you. So ultimately you have to pay, but the thing is there is no counterparty risk because exchange or the middlemen, the clearing and settlement agents, they stand in between. Okay, so they take on the counterparty risk, so they are much safer. Okay, so difference between forwards, these are exchange forwards and futures. Futures are exchange traded, they are standardized, there is no clearing and settlement risk. There are a few other differences that we will discuss when we go through the slides. Now, what is issue with forwards and futures? The issue is you can make a lot of profit if the trade goes your way, but you can make a lot of loss if the trade doesn't go your way. So if Facebook stocks keeps on going up, buyer will keep on making profit, but if it starts falling, you will start making losses. And like we discussed in margin trades, futures will also generally require an initial deposit. So you don't have to put in the entire amount, you just have to deposit a small amount to make a big trade. So there is concept of initial margin like we discussed in margin trades in the previous module. So initial margin means you don't have to deposit the entire amount, you only deposit a part of it and you trade on a bigger chunk. So let's say Facebook is at 140 and if you are trading in one lot that is of 100, so 140 into 100, so you're trading stocks worth 14,000, but generally you would have to deposit, let's say 5% of it, that's it. So you can trade by putting in just $700 stocks that are worth 14,000. So profit and loss are magnified and they can be big. So you can lose all your money plus extra money, and you can make a lot of money also when you trade in futures. And this double-edged sword happens because there is rights as well as obligations. So as a buyer, you have right and obligation to buy whatever is the price. You have right when the stock price goes up and you are making profit, but you have an obligation when the stock price falls and you are making loss. Same way, seller also has right and obligation to sell. So it's a double-edged sword. You can make a lot, you can lose a lot. So how do we counter this shortcoming? So this shortcoming is countered through the use of options. Now there are two types of options, call option and put option. I'm going to discuss call option first. Now option means buyer just has the right, there is no obligation on him. So if he is in profit, he will execute the trade. If he is not in profit, he will not execute the trade. Before I forget, futures are traded up to 9 months. So whenever you are trading on exchange, you can trade up to 9 months in future. So you can buy and sell some stock, or you can even buy and sell some index 9 months in future. Now let's say we are discussing options. So options gives you only right, but there is no obligation, okay, as a buyer. So we are discussing first call option. Now there are two parties. There is a call option buyer and there is a call option writer. Call option buyer has right to buy but no obligation call option writer has obligation to sell, but only when buyer executes. Now these are fancy words, I'll explain it to you. So let's take an example. Let's continue the example of Facebook. So Facebook stock call option is trading like this. So the price of execution is $140. It's a 3-month call, so within 3 months you can execute it, and you can, if it is an American option, you can execute it any day. Most of the options that are traded on traded in North America are on stocks are basically American options. On indexes they may be European, but for time being just consider that you can execute any day. Okay, so within 3 months you can execute any day at $140, and it's a call option, so you can buy any day at $140, and this option is trading at $10. So $10, it's the premium. So what does it mean? So as a buyer you click on buy. As a buyer of call option you click on buy. So what do? You pay $10 as premium to writer. Premium once paid is never returned. So premium is a cash outflow that you will never get back. So you pay $10 to writer to buy this option. After paying premium, what do you get? You get right to buy Facebook stock at $140 any time in 3 months, but there is no obligation on you. Okay, no one can force you to buy it. If you want, you can, otherwise you can just let it go. So after paying premium you get this. Now imagine if Facebook starts trading at $180. What would happen? Everyone else in the market is buying Facebook at $180. Because of this contract that you bought, you have a right to buy Facebook at $140. Would you buy? Everyone else is buying at $180. You have the right to buy it at $140. Of course you will buy, because you're getting a better price than market. So you execute. So what is your profit? The thing that was trading at $180, you are buying at $140, but you paid a $10 premium. So your profit is $30. So by paying $10, you got $30 back if stock goes to $180. Now, if stock falls to $100, what would happen? If it was future, you would suffer a loss because you had an obligation to buy at $140 when the stock was trading at $100. But this is not future, this is option. Do you have any obligation? There is no obligation. So you decide not to execute this contract. So what is your loss? Your loss is $10 that you paid. So just think back. You can rewind the video and see it. You can go back and play again. Okay, so loss is only the premium paid, but profits can be big. So what is a call option? Call option means you profit, you make money when price goes up, or you make profit when price goes up above your execution price. Okay, and you lose money when price stays same, because premium paid is not returned to you, and you will not execute if price is $140. There is no advantage in executing. Or if price falls, so you lose money when, so there is a loss if price remains same or price falls. But the fun part is loss is limited to premium paid. This is call option. Call option gives you right to buy an underlying at a specified price, but there is no obligation. It makes money when price goes up. It loses money if price goes down or it remains same. Maximum loss is always the premium paid. You cannot lose beyond that. So call option is a mechanism of getting small losses and betting on big profits. Okay. Next is put option. What is put option? It is right to sell but no obligation. It is right to sell a stock but there is no obligation at a specific price within a future duration. So let's say same thing with Facebook. $140 is the Facebook price. You have a 3 months put trading at $10 and you decide to buy this put option. So when you decide to buy, you pay $10 as premium. Premium once paid is never returned back to you, so it's a cash outflow. You'll never get it back. But because you have paid this premium, you get right to sell but no obligation at $140. So anytime in future you can sell Facebook at $140. Now if Facebook goes to $100, everyone else in the market is selling Facebook at $100. Because of this contract, you have a right to sell Facebook at $140. So something that is at 100, you can sell at 140. So you are making profit. So you are selling at 140 where everyone is selling at 100. But to buy this, you paid $10. So you make a profit of $30. If Facebook goes to $200, if you were seller in future, you would make a loss because you had an obligation to sell at 140 when the price was 200. But this is not future, it is options. So you have right, but there is no obligation. No one can force you. So you may decide just not to execute. You will not buy stock that is worth, you will not sell stock that is worth 200 for 140. So you give up your premium. So $10 is your loss. So what is put option? Put option is right to buy, right to sell at a predetermined price but no obligation. So when price goes down, you make profit. When price goes up, you make loss, but loss is limited to premium paid. Okay, so these are options. Now let's get back to slides and discuss it. Okay, so types of derivatives are forward, futures, options, rights and warrants. Rights and warrants we are going to discuss along with the slides. So what are forwards? Forwards are contract between buyer and seller. Both parties have obligation. So both parties obligate themselves to trade the underlying asset in future at a price agreed upon today. Neither party has given other any right. So you have both rights as well as obligation. They are both obligated to participate in future trade. A forward contract in which is a one in which obligates one party to buy and another one to sell a defined amount of underlying asset at an agreed upon price at a specified time in future. The buyer does not pay the agreed upon price right away, nor the seller pays anything. That is, seller doesn't deliver right away. They both do it in future. Payment and delivery takes place at a specified time in future known as the delivery date. The delivery price is agreed upon when the contract is entered. So what are you doing? You're buying and selling at a future date at fixed price. OTC equivalent of future contracts that can be customized. So they are traded on over the counter, they are not traded on exchanges, and they are extremely customized. Next is future. Future contract is an exchange traded contract. So difference is they are exactly same as forwards except they are traded on exchanges. Exchange traded forward agreements between two parties in which one party is obligated to buy and the other party is to sell an underlying asset. So they are standardized in quantity and quality. They have an agreed price upon today and they generally execute at a future date. Now future contracts have margin requirements. So there is initial margin. So the margin that you have to deposit if you want to get into a contract, and you have to keep a maintenance margin also, the minimum account balance that must be maintained if the contract is open. So how it works, as a buyer and as a seller, you put in initial margin to trade. If you make profit, the margin goes up. There is mark to market. So if you are making profit, the margin value goes up. If you make losses, the margin value comes down. Now there is a minimum level that you have to maintain. If due to losses you hit the minimum level, you get a margin call. You have to either increase the margin or close the trade. Both are set by exchanges on which contract trades, but firms may generally impose higher rates on clients. Now there is a concept of mark to market. So daily settlement of gains and losses happens. So changes in price of the contract from the previous day will lead either to a payment by the long position to the short or vice versa. So either the buyer pays or the seller pays depending on the price movement. Payment is not made directly between the long and short, but is instead between the counterparties, so respective investment dealers through the clearing house. So there is a clearing house who guarantees the trade. Why buy future contracts? Investors buy future contracts either to profit from an expected increase in price or to lock in the purchase price. So if you're buying certain stocks and you want to lock in the purchase price, you can buy a future contract. If you're selling certain stock in future, not right now, but you want to lock in a certain price, you can sell a future contract. So you can either speculate or you can cover your risk. So investors buy future contracts either to profit from an expected increase in the price of the underlying asset or to lock in a purchase price for the asset on some future date. Speculation, it is attempting to profit from an expected increase in the price of underlying asset. Risk management, it is locking in a future price for the asset. Why investors sell future contracts? Investors sell future contract to profit from a decline. So buyers profit when price goes up, sellers profit when prices decline, or to lock in the sales price of a particular asset on some future date. So speculation is attempting to profit from an expected fall in the price, and risk management is locking in the future price for an asset. Now exchange traded and OTC derivatives. Derivatives trade either on an organized exchange as exchange traded derivatives called as futures, or they trade off an exchange called as over the counters or forwards. OTC network is dominated by banks and financial institutions who trade directly with corporate clients and other financial institutions. When a forward based derivative trade on an exchange, it is typically called a future contract. Now this is difference between exchange traded and OTC. So exchange traded, that is futures, they trade on exchange. OTC contracts trade through computers and or phone lines, so they trade majorly on the dealer network. These are standardized contracts, so standardized in terms of quantity as well as quality. OTC are extremely customized, so you can decide, which means both parties can decide what to buy and sell. These are transparent, these are private because numbers are shown, how much trading of future happen is generally visible. Forwards, no one knows how much trading happens because they're private. Easy termination is possible before the contract expiry because you can sell your obligation on secondary market, right? You can get into a counter trade. So if you have bought futures, you can sell futures to balance out. If you have sold futures, you can buy futures to balance out. But on OTC, termination is more difficult. Clearinghouse is the third party. So clearinghouse guarantees the trade. There is no third party. Performance bond or good faith deposits are required. So you have to deposit initial margins to trade in futures. There is no performance bond or good faith deposits. Marking to market. So profit and loss are adjusted each day. Profit and loss are settled at the end. These are extremely heavily regulated. There is not much regulation in OTCs. Delivery rarely takes place, so mostly they are cash settled. So if I am losing, I pay in cash. If I'm gaining, I get paid in cash. And OTC, delivery can happen or final settlement can happen. Then in exchange traded, commissions are visible. In OTC, fees are built into the price, they are not explicitly visible. Exchange traded are majorly used by retail investors, corporation and institutional investors. OTCs are majorly used by corporations and financial institutions. Now underlying assets can be anything. It can be commodities like wheat, corn, soybean, sugar, cocoa, coffee, crude oil, natural gas, propane, copper, aluminium, silver, platinum. Major volumes are there for oil. Financial assets can be equity stocks as well as equity indexes. More volume for equity indexes vis-a-vis stocks. They can be interest rates or they can be currencies. Uses of derivatives. So there can be different users. Individual investors. So small retail investors can speculate on derivatives. There can be institutional investors like pension funds and mutual funds and hedge funds. There can be business and corporations who buy currency derivatives or interest rate derivatives because they're covering their risk, or there can be derivative dealers. Why derivatives are useful? Because it helps to reduce risk. So example that we took in terms of India means in terms of China and Canada. So China was reducing the risk of oil prices going up and Canada was reducing its risk of oil prices going down. So hedging is an attempt to reduce or eliminate the risk of either holding an asset for future sale or anticipating a future purchase of asset. Hedgers start with a pre-existing risk that is generated from normal course of business. Hedging is accomplished by taking a counter or opposite position in the derivative instrument of the asset to be hedged or one that is very close to it. Then you can also use derivatives for market entry and market exits. Sometimes it is very difficult to buy stock or sell stocks. So if you want to take advantage of price going up or down, you can easily do it in futures rather than actually selling and buying stocks. Then you can enhance your yield. So you can bet and increase your yield, or you can arbitrage. So buy in one market and sell in another. Next is options. Options are contract between two parties, a buyer and seller. Buyer has the right but no obligation to buy or sell a specified quantity of underlying asset in a future at a pre-agreed price. Seller is obligated to complete the transaction but only if buyer executes. Primary difference between options and forward. An option holder has the right while forward holder represents an obligation to buy or sell in future. Option have a trigger point known as the exercise price above or below which it has an expiration. So trigger point means the price is set at what price you will buy or sell. Forwards has no trigger point, they develop value as soon as market price changes. The price of option requires purchase of option requires an immediate payment, so you have to pay premiums to buy options. No money needs changing of hands when you buy and sell futures or forwards. Option terminologies. So there is a writer, the seller of option who is obligated to act. Then there is strike price, the fixed price at which rights given to buyer can be exercised. Expiry, the month the contract expires, usually Saturday following the third Friday after expiration. Contract size, they are generally traded in multiples of 100. Premium, the price paid for option, so buyer pays premium to writers. American style option, an option that can be exercised anytime up to and including the expiration date. Most of the options are American, so that are traded on stocks. European style option, an option that can be exercised only on expiration date, so you can execute only when the expiration date is there. Within that time you cannot execute. Buyer or holder, the holder of option with right but not with obligation. Opening transaction, buying or selling an option to initiate a position. Closing by offsetting, exercising or expiring worthless. So you open a transaction by buying an option, but there are different ways to exit. First is, you can, if you have bought a call option, to counter it you can sell a call option to close. Then you can exercise if you are in profit, or you can let it expire worthless, so your premium goes away. Long position, the buyer or holder of option is called a long position. A short position is the seller or writer of option. Assigned is when long or the buyer executes the trade, that is exercises his option. Intrinsic value, the value of certainty, the in the money portion of call or put. So if you are making profit in option, if the price goes above your exercise price, then the options are called as in the money. If price is below the exercise price, then they are out of the money. Time value, the value of uncertainty, the amount an option is trading above its intrinsic value. So when you see the premiums that you pay, generally part of it is because the options are in profit, and part of it is because of time value, that is uncertainty. Types of option, there are calls and puts. So call gives holders right to buy and writers have obligations to sell. Put has holders right to sell and writers have obligation to buy. So option position, so call buyer pays premium, call writer receives premium. Call option is right to buy the underlying asset, call writer is obligation to sell at a fixed price. Put option is right to sell, put option pays premium, put writer receives premium, put writer has obligation to buy. Options generally have leverage. So example, suppose you believe the price of company stock was going to rise from 50 to 75, you can purchase 100 shares or an option contract. So they are giving you examples. If you buy 100 shares at 50 and the stock goes to 75, you make profit of 2,500. But let's say one call option contract is at $5, so you buy one contract by paying $5 per stock into 100 stocks, that is $500, and when the price goes to 7,500, you make a profit of 2,500, but you have already paid 500, that is not returned to you, so you make profit of 2,000 by paying only 500. So percentage profit is more. Option risk, a call option buyer can only lose premium, option writer has loss of big capital, so unlimited loss if writing a naked call. So we'll discuss what is naked call and what is a covered call. Put option buyer loses premium, but put option writer can make a large loss if price falls heavily. So writers have more losses, alright, buyers just have premium that they lose. Option valuation, so call option is in the money if market price is above the strike price. So let's say your execution price in Facebook was 140, but the market price is right now 160, so your option is in the money. So if market price is greater than strike price, your option is in the money. If market price is less than stock price, if price is, let's say if it is a put option and price is 120 when the exercise price was 140, then you are in profit. So for call options, they are supposed to be in the money when market price is greater than strike price, and put options are in the money when market price is less than stock price. Out of the money options, so call options are out of the money when market price is less than stock price, and put options are out of the money when market price is greater than stock price. So you will not make any profits if price goes down. So that's why market price, if it goes down than the strike price, you make losses. So you're not making any profit. Intrinsic value, the in the money portion of options price. Time value is option premium that you pay minus the intrinsic value. Option pricing, intrinsic value is market price minus strike price. Put option, it is strike price market minus market price. So this you have to remember. For call option, it is market price minus strike price, that is in the money part, and put option, it is strike price minus market price, that is intrinsic value. Time value is always market value of the option, that is premium that you paid minus intrinsic value. Example, they have given XYZ 50 call, XYZ company's December 50 call is trading for 7.25 when the stock price is 56. So it's a call option. So price is 56, you can execute at 50. So are you in profit? Market price is 56, you can buy it at 50. So you're in profit of $6. $6 is intrinsic value. But how much is the option trading at? Option is trading at 7.25. So 7.25 minus 6 is time value. So intrinsic value is how much profit are you making. Time value is how much have you paid above the profit. The option is in the money. Okay. Same way, June put is trading at $4.85. Execution price is 25. So you can sell at 25 and the market price is 21. So are you in profit? Yes, because everyone else is selling at 21, you can sell at 25. So you are in profit of $4. Intrinsic value $4. Time value, how much did you pay? 4.85. What was the profit? 4. So 85 cents is time value. It is in the money option. Okay. So option expectation. So call buyer generally thinks that price is going to go up. Writer thinks price is going to go down or there is no change. Put buyer thinks that price is going to go down. Put writer thinks that price is going to go up or there is going to be no change. Why do we use call? Buyers use call for additional income by buying the stock or reducing the net cost of money. Means why do we use call? So additional income or greater leverage, and writer use it for against buying the stock. So I'll explain it once we discuss covered call and put. And also to reduce the cost of the investment or locking in the future price and protecting a short, you can use for call. So this is important. Call writing can be covered or naked. So what is a covered call writing? So you have shares and you write the call. That is a covered call writing. So what you do, based on the amount of shares you have, let's say you have 100 stocks of Facebook which are priced at 140. So you have $14,000 worth of Facebook stocks. Okay. And then you, or $140,000 worth of Facebook stock, and then you write a call option. So writer owns the underlying share. So if you are assigned, you sell the stock and you give money to buyer. You keep the premium if you are not assigned. So if buyer doesn't execute, you keep the premium. If buyer executes, you sell your stocks and pay him. So you have less risk. You may be able to lock in your profits. Naked call, writer does not have any underlying stocks, right? But you still write. So if the buyer assigns you, you have to pay from your own pocket and it can be a large amount. So it's a highly speculative position. If assigned, must purchase the securities at higher price, then sell them at a lower strike price. So you can make a large loss. Why can you use put? So holders use put for earning additional income. Then there is lesser risk, and you use it for acquiring stock at a net price. You look at the future price, right? Protecting an existing position. So all of these are uses of put. Put writing also, it is cash secured or naked. Cash secured means writing a put. So you have put options, you're writing a put and setting aside cash. So whatever cash is required, you set it aside and then write a put. Invest in short-term liquid money market instruments like T-bills. If assigned, you buy the shares and give it and sell it. Naked put, no position in stock, no cash set aside to purchase the stock. It is highly speculative and you want the price to remain at or above the strike price. If it falls, then you are in huge losses. So summary of options. If you are a buyer, your belief is stock price will rise. You will exercise or sell if the price rises. Your risk is lose cost of investment, that is premium. Put option, your belief is stock price will decline as a buyer. You will exercise or sell if the price falls, and your risk is you may lose the premium. As a writer of a call option, the stock price will decline, that's the risk that you have. Your action is none, or you can buy back the option. Your risk is you must sell stock at the strike price no matter what the price is. Put option, stock price will increase is your belief. You take action of none, or you can buy back options at a later date. Your risk is you must purchase the stock at strike price. Next is write warrants and option. Write warrants and call options share certain characteristics. Each gives the holder or buyer the right to purchase additional stock at a specified time until expiry. So how do they differ? So first is write. Write is a privilege granted to existing shareholders to acquire additional shares directly from the issuing company. So issuing company to raise capital by issuing additional common shares, a company may offer shareholders the right to buy additional shares in direct proportion to the number of shares they already own. So what is right? If I have certain shares, the company can issue me rights. That is, in future, I can buy the company's share at X price, irrespective of market price. So it's like call option. I get the right to buy, but there is no obligation. For example, the offer may be based on right to buy one additional share for each 10 shares that you have. So again, there is a period of come right and X right period. So come right period means stocks are trading with rights, and X right periods means the stocks are not trading with rights. So value of right options in come right period is X minus X divided by N plus 1. That is value of right in come right period. So it is stock price minus the exercise price, how much price it is above, and you divide it by N plus 1, whereas N is number of rights required to purchase one new share, and in X right periods you divide it by N. Now this is an example of how it works. So ABC Inc. declares right offering. Shareholders of record as on Friday 16th July were granted one right for each share that they have. 5 rights needed to subscribe for each new ABC share at a price of 23. The rights expired at the closure of business day on 18th August. So share price were given as follows. So these are the share price on different dates. Record date was 16th of July and you can buy the share at 23. So when will share begin to trade X rights? So it's same as dividend. One day before the record date, stocks start to trade X right. So all these are come right shares and all these are X right shares. Okay. Next is what is the intrinsic value of right on the last day of come right. So you can use the formula. And what is the intrinsic value on first day? Same, use this formula. Difference is come right, you have to divide it by n plus 1, and in X right period you have to divide by n. So S minus X divided by n plus 1 in come right, and S minus X divided by n in X right, where S is strike price, S is market price. So market price is these prices and X is execution price, that is 23. So it will be 26.50 minus 23 divided by n plus 1 because it's come right. And from here on 15th onwards it will be X right. Next are warrants. So warrants provides the holder with an option to buy shares in the company from issuer at a set price for a set period of time. So warrants are exactly like options, but they are long-term options. Warrants are often attached to new debt or preferred issues. So they're exactly like call option. Call option gives you right to buy. So let's say you get a right to buy Facebook stock at 140. Same way, if a warrant is issued, you get right to buy Facebook stock at 140. Whatever is the price. If price is even $200, you will still be able to buy it at 140 if you hold a warrant. Warrants are often attached to new debt and preference issues to make these issues more attractive to buyers by giving the buyer of a new issue the opportunity to participate in capital gain. So intrinsic value is easy. So warrant entitles the owner to buy one stock at a price of 40. The warrant has a market price of $5 and the shares are trading at 42. So what is intrinsic value? So are you profitable? So you can buy shares at 40 when the price is 42. So you're profitable. How much? $2. So intrinsic value is 2. Now how much did you pay to buy this warrant? You paid $5. So time value is 5 minus 2. That is $3. Assume that in this case the common share trade at 35 per share, so there will be no intrinsic value because 35 minus 40 is 0. Time value will be $5. That's it. I would urge you to watch this recording once again and read the book carefully. This is an important chapter and it's a difficult chapter.